Welcome to our weekly Forex and Gold forecast. My name is Jay Norris, and I teach trading at Trading University. As always, we want to remind you that trading involves risk of loss and is not suitable for all investors. First market we're going to cover is the Australian US dollar. Aussie US dollar, you saw some strength, you saw it recover, kind of no surprise there. We were saying a couple of weeks ago that we think you'll probably see a higher high here. In fact, 96 even is our overall target. That 96 even would be a 50% retracement of this entire move down. You go back to the spring of 2013, that high to this low would equate to a 50% retracement. We think that's a pretty good possibility. Basically, this leg here, you had a leg down that retraced 50% in here. Now we think this, before you had a second leg down, we think this overall move, that two-leg move down, that kind of big A, B, C there, for lack of a better term, we think that overall move will retrace, and we think 96 even is likely in the cards there. So we think you see a round of potential Aussie strength here that may dovetail with a bit of a correction, a bit of pullback in the U.S. dollar. So the Aussie, it's got to make hay now. If you see dollar weakness, that probably will open the door to that 96, the figure level we're looking at. Next market, the dollar Swiss, and here's where we think you can see some short-term dollar weakness. You had a big turnaround, you had a big climax on the upside on ECB meeting, a big climax on the upside, and then you turn it around hard, but you still haven't done a whole lot of technical damage. But that doesn't mean you can't meander sideways to lower a bit in here, and you're probably overdue for a bit of a correction here. But here's what's really interesting about the Swissy. You have a higher high here now, right? You had the big double bottom, you had a higher high, we've been talking about that. Potentially you put in a lower high here, and then you have a rally and eclipse that high, and guess what? You will have shook in this bear market, and you'll be into a new bull move. So that's what we're watching. We're going to see if how far this market retraces as far as gauging the strength of this budding bull market right here. So we'll have to see how that turns out, if in fact the market does put in a higher low and then a resumption of the upside. Next market, dollar index. Dollar index, increasingly important market for us. You're seeing increasing volume in the dollar index futures. Here's the case where same thing, you had a climax, you put in a climax high, you had a pretty good shorter term reversal, but you haven't done any technical damage. You got no follow through on Friday. That's no surprise. Fridays are really not follow through days. You get the weekend coming up, and no one really wants to commit ahead of the weekend. Bottom line, you really haven't done any technical damage just yet with Thursday's correction on the ECB number. In fact, you put in a pretty good showing on Friday. You got a green candle there. So as far as your shorter term trends, your intermediate term trends, they're still bullish here. So you didn't do a lot of technical damage. Dollar index still looks to be pointing higher. I think the question is similar to the Swiss we just looked at. If you do get a correction in here, how far will it be? Shallow correction indicating the overall move is stronger, steeper correction, weakness. So again, you're looking for a potential higher low in here, and all eyes be attuned on that, and pan out to a weekly dollar index chart, and nothing's changed here. We've been saying all along, this is a bullish chart. You have a rally, and then you have a big sideways move. Big rally, big sideways move as it consolidates itself. So we think you get closer and closer to a breakout in the dollar on the upside, and we think we think it's safe to say that would be a sea change reversal for just not the dollar, but the currencies overall as you enter an era of dollar strength. Then euro, next market. Here's the euro weekly chart. Similar, you have what we see is a bear move down. This is going all the way back to the 2011 high. You have a big bear move down, then you have a bullish correction. Dow theory says that a market can retrace up to 2/3 and maintain its primary pattern. That's what we see in the euro. You had a big move down in the euro. It retraced 2/3, almost to the tick there. Right around, you had a 2/3 retracement. Market topped out with a double top, and now it's potentially reversing lower. So we think that's pretty telling of what's going to go forward, and we're calling this a potential sea change move. Let me drop down to the daily chart. You can't call it a sea change move, however, until we put in a lower high, right? You have the lower low to that low, so you broke this pattern of higher highs and higher lows. Higher low pattern was broken here. You put in a lower low. However, now what do you need To complete that, you'd need a lower high and then a resumption of the bear move. So we've drawn some Gann lines here. Here you got that Dow 2/3. You've got some Gann lines that looks like a 75% and then an 875. So pretty good potential resistance ahead. And in this rally, if you have some kind of a corrective rally higher here in the euro, that's going to help us gauge the strength of this new bear move we're looking at. So pretty important. And if you do, if you do get the lower high and then a resumption of the downside and increase in volume, that's a sea change move. That'd be a big deal for the currencies. We wrote an article, we penned an article, and we were calling it the golden age of currency trading, and it really would be, because sustained moves, what the currencies are known for long term. So if we were to get a sustained move lower here in the euro, sustained move higher for the dollar, the Swissy, that would be the dollar Swiss. That would really be something for traders. That would definitely be to our advantage as traders. Next market, the gold. No surprise, we took a break last weekend, got away. It was nice. And before that, we talked about the potential for a meltdown in the gold market, and you saw it. You definitely saw it. We kind of sniffed that one out. The market couldn't rally, and in a market that can't rally and that everyone has to pay a carry on it, there's no interest on it, that's a weak market, and that's the potential for a weak market. And so that's what we saw in the gold. We saw a meltdown in the gold there. Kind of no surprise there. Let's see where gold stands now. Anytime you go beyond that Dow 2/3 retracement, that's not good. That's weakness. And there you have it right there. You did go beyond 2/3 retracement. You went beyond the 618, 625, beyond 2/3. So that gold, not a healthy market overall. In fact, I guess we could look forward to continued weakness, and that dovetails overall with our strong dollar thesis. Also, dollar yen last market, and this is an interesting market because we talked about this market having strength, showing strength long term. You had a nice big rally, then you had a sideways consolidation. The 50% level continues to hold. You can't even break down towards that 618. So the 50% is holding, and now you got a nice rally off of it. So here's another one where this dovetails overall with that potential sea change move higher for the dollar, lower for the euro, vis-a-vis dollar strength. Potentially you could see dollar strength here if this breaks out of this pennant formation, and that'd be pretty bullish. So dollar yen overall looking pretty bullish also. Hey, that'll do it for us. I'll leave you with this thought, one of my favorite quotes from Bill Williams. It says, all we need for the market is for it to provide us signals so we can take the appropriate action. Thank you so much. My name's Jay Norris, and we'll see you next time.